Choosing between stocks, exchange-traded funds, ETFs, and mutual funds is one of the most important decisions an investor can make. Each of these investment vehicles offers distinct advantages and disadvantages, and understanding their differences is key to building a portfolio that aligns with your financial goals, risk tolerance, and investing style. With the multitude of options available today, making the right choice can seem overwhelming. However, by examining how each works, how they perform in different market conditions, and what types of investors they suit best, you can begin to navigate this complex landscape with confidence. Stocks represent individual ownership in a specific company. When you purchase shares of a stock, you're essentially buying a small piece of that business. This direct ownership allows investors to potentially benefit from both capital appreciation and dividend income. The appeal of investing in individual stocks lies in the possibility of high returns. If you choose the right company at the right time, your investment can multiply significantly in a short period. For example, investors who bought into companies like Apple or Amazon early in their growth phases saw their money grow exponentially. However, with that potential reward comes substantial risk. Stocks are volatile and subject to daily fluctuations based on factors such as earnings reports, market sentiment, geopolitical events, and even rumors. This makes them ideal for investors who have a higher risk tolerance, a good understanding of market dynamics, and the time to research and monitor their holdings closely. ETFs are a relatively newer innovation in the investment world, but they've become incredibly popular due to their flexibility, low cost, and ease of use. An ETF is a basket of securities, typically stocks, bonds, or commodities, that trades on an exchange like an individual stock. When you invest in an ETF, you gain exposure to a wide range of assets in a single transaction. This diversification helps reduce the risk that comes with investing in a single company. For instance, an S&P 500 ETF gives you fractional ownership in 500 of the largest U.S. companies, effectively spreading out your risk across the entire market. ETFs are known for their transparency, low expense ratios, and tax efficiency. They can be bought and sold throughout the trading day at market prices, which gives investors more flexibility than traditional mutual funds. Because of their structure, ETFs are suitable for both beginners and experienced investors who want to create a diversified portfolio without the complexity of picking individual stocks. ETFs are known for their transparency, low expense ratios, and tax efficiency. They can be bought and sold throughout the trading day at market prices, which gives investors more flexibility than traditional mutual funds. Because of their structure, ETFs are suitable for both beginners and experienced investors who want to create a diversified portfolio without the complexity of picking individual stocks. Mutual funds, on the other hand, pool money from many investors to purchase a diversified portfolio of assets, managed by professional portfolio managers. When you invest in a mutual fund, you're buying shares of the fund itself rather than individual securities. These funds come in a wide variety of types, including actively managed funds that aim to outperform the market and passively managed funds that seek to replicate a specific index. Mutual funds offer diversification and professional management, which is appealing to investors who prefer a hands-off approach. However, they often come with higher fees than ETFs, especially if the fund is actively managed. Another drawback is that mutual funds are priced only once per day after the market closes, meaning you can't take advantage of intraday price movements. Still, for long-term investors who value convenience and professional oversight, mutual funds can be a valuable component of a well-rounded portfolio. When deciding which of these investment types is right for you, the first step is to assess your financial goals. Are you investing for long-term growth, income, or capital preservation? If your goal is aggressive growth and you have a high risk tolerance, investing in individual stocks might be appropriate. Stocks offer the potential for significant gains, but also come with the possibility of steep losses. If you have the knowledge, time, and emotional discipline to ride out volatility and thoroughly research companies, stocks can be a rewarding option. However, if you're seeking a more balanced, less hands-on investment strategy, ETFs or mutual funds might be more suitable. Your time commitment and interest in active investing also play a big role. Investing in individual stocks requires ongoing research, monitoring financial news, and analyzing earnings reports, industry trends, and company fundamentals. Not every investor has the time or desire to dedicate to that level of involvement. If you prefer to invest without having to actively manage your portfolio, ETFs provide a passive approach that still delivers diversification and market exposure. For even less involvement, mutual funds, especially those within retirement accounts or managed portfolios, can provide a set-it-and-forget-it option where professionals handle the decision-making on your behalf. Another key factor is cost. Expense ratios, trading fees, and minimum investment requirements can vary significantly among these options. Most ETFs have low expense ratios and can be purchased without a minimum investment amount through modern online brokerages. Stocks also typically have no management fees, though there may be trading commissions if your brokerage charges them, which is becoming less common. Mutual funds, especially actively managed ones, tend to have higher fees, which can eat into your returns over time. Some also have minimum investment thresholds of $1,000 or more, which can be a barrier for new investors with limited capital. Fee-conscious investors may find ETFs to be the most efficient choice, especially when investing small amounts regularly. Tax efficiency is another area where ETFs often outperform mutual funds. Due to the unique in-kind redemption process used by ETFs, they tend to generate fewer capital gains distributions than mutual funds. This means you could potentially owe less in taxes on your investment returns. Mutual funds, by contrast, may distribute capital gains to shareholders each year, even if you haven't sold any shares yourself. This can lead to unexpected tax liabilities. Individual stocks are also tax efficient in the sense that you control when to sell and realize capital gains or losses, giving you more control over your tax situation. Liquidity is important, particularly if you may need to access your money quickly. Stocks and ETFs can be traded instantly during market hours, offering high liquidity. Mutual funds, however, can only be bought or sold at the end of the trading day at the net asset value, NAV. This may not be an issue for long-term investors, but it's something to consider if flexibility and fast access to cash are priorities for you. Additionally, some mutual funds charge early redemption fees if you sell too soon after purchasing shares, which can reduce your effective returns if you're not planning to hold the fund for an extended period. For beginners, ETFs are often considered a sweet spot. They offer the simplicity of mutual funds and the flexibility of stocks. You don't have to pick individual companies or time the market, but you also have more control over your investment than with a mutual fund. Many ETF providers also offer themed funds that focus on specific sectors, regions, or trends, allowing investors to tailor their portfolios according to their interests and convictions. This makes ETFs a good learning tool for those new to investing, as they expose you to a wide variety of companies and industries within a single product. If you're investing for retirement, your choice might also depend on the type of account you're using. Many employer-sponsored retirement plans like 401ks offer a limited selection of mutual funds, so your options may be restricted. IRAs and brokerage accounts offer more flexibility, allowing you to choose between stocks, ETFs, and mutual funds. If you're using a robo-advisor or automated investment platform, your money will typically be invested in a diversified portfolio of ETFs, aligning with your risk tolerance and goals. For those who prefer not to manage their investments directly, this is an easy way to get started and stay consistent. Ultimately, there is no one-size-fits-all answer when it comes to choosing between stocks, ETFs, and mutual funds. Each has unique characteristics that can support different financial strategies. Many investors actually use a combination of all three, tailoring their portfolio to balance risk, cost, growth potential, and convenience. For example, you might use ETFs for broad market exposure, individual stocks for targeted bets on companies you believe in, and mutual funds for retirement, savings or exposure to niche strategies. Managed by professionals, the blend you choose should reflect your financial situation, goals, and investment personality. In the end, the best investment choice is the one that you can stick with over time. Discipline and consistency are more important than chasing the hottest stock or trying to time the market. By understanding the key differences between stocks, ETFs, and mutual funds, and by aligning those differences with your personal goals and risk tolerance, you give yourself the best chance of building a portfolio that grows with you. Investing is not a race, it's a journey, and choosing the right vehicle can make all the difference in reaching your destination.